These are very, very important changes. And I think that, it's not just gold. And actually, it's not just silver. It's the whole of the metals complex that is likely to be affected this way.
And I think in the next 3 to 5 months, you'll see a different reality than what we've seen.
Yeah, okay. Well, it's been priced only really as an industrial metal. And as an industrial metal, it has been suppressed. And I think that the guilty party is China. Bear in mind that China in 1983 gave the People's Bank of China sole responsibility for acquiring gold and silver on behalf of the state. And so I think it has been dealing with silver not only as an industrial metal, but also as, if you like, a precious metal, which is in reserve number 2 to gold. And bear in mind also that China was last on a silver standard in 1935. So this is actually quite recent, if you like, in the long history of China from Confucius days until now. So you can see that that's the case. Now, we know how, or at least I know how they accumulated gold. They had a bear market. They started doing it in 1983. You had inward investment, which, because the other thing that the People's Bank did was it controlled completely foreign exchange transactions. And so everything, all foreign exchange transactions, inward investment, and so on and so forth, all went through the bank. And later on, of course, as these investments, factories and so on and so forth, bore fruit, and exports started increasing, that again was foreign exchange transactions going through the People's Bank of China. So it was quite easy for the PBOC to accumulate gold. The mystery has been how they've done it with silver. And I think the answer was quite simple. If you go back 20 years or so, you'll see that virtually every country in the West gave up processing silver or made it more expensive simply because it's a pretty dirty business. The Chinese basically were quite happy to import loads of silver doré and refine it for themselves. And the way they controlled the market, I think, was really quite simple. They would work with a major bank like JP Morgan. JP Morgan would, on behalf of the Chinese, sell forward to, in theory, cover their position in silver. But of course, it was actually just a suppression scheme. So what you had was silver doré bypassing the market, but the hedging going into the market and driving down the price. I think it was really as simple as that. Now, China, I think, is changing that. And I think that we got a very clear signal when President Trump had his Liberation Day. At that stage, I think that China, even though perhaps before it was already beginning to scale down its sales of futures, if you like, and other means of controlling silver, I think it was scaling it down. And I think that that Liberation Day basically meant that China came out of the market and was no longer suppressing silver. And so we can see that further moves have taken place, such as the Shanghai Gold Exchange saying that it will open vaults outside China for the first time. And at the same time, the Shanghai Futures Exchange has said that it will open itself up to foreigners participating on that market. Now, you could participate in it before, but you would have to set up a Chinese entity in order to deal. You couldn't deal direct. That's now gone. So these are very, very important changes. And I think that it's not just gold, and actually it's not just silver, it's the whole of the metals complex that is likely to be affected this way. So I think with silver having been left behind because it's been suppressed over a long period of time, we got to the point where the gold-silver ratio was up at 106. It's now fallen down. It went down to about 90. It's about 93 at the moment. I think that's going to go a whole load lower because people who've missed the boat in gold are going to say, well, silver hasn't gone up that much. We ought to get into that because look at the gold-silver ratio. It is still far too high. So that's, I think, roughly where we are. It's actually a very good outlook for the price of silver. And it's a turbocharged way, if you like, of getting out of credit, getting out of fiat currencies.
You've heard Alasdair Macleod lay out the big picture, the cracks in the system, the gold rush underway, and the dollar under fire. But now we go from the why to the when. Michael Oliver steps in with the technicals, and what he sees in silver's price action could change everything.
Well, yeah, Alasdair just gave some good background stuff about, the rationale for why it should come up out of here now. because of these events going on. And I try to blindfold myself to these things because I don't know how to time them, but they are there. We know it. And you can't alter reality forever. Ultimately, reality wins. And so if something's been held back for too long, it's likely that when it unleashes, it'll unleash even more than if it had been let to do it before. But the technicals are what we're looking at. And I don't just mean price. We look at long-term momentum of silver and gold. And we measure price in relation to like 3-year averages, 3-quarter averages, and so forth, not just day-to-day or week-to-week stuff, the noise. And when we measure it, we create an oscillator, and it creates a different visual picture than when you look at a price chart. It develops its own trends. Sometimes they aren't even evident on price yet. Well, we just broke out a week ago. Silver had made, remember, over the last year, the high in silver last May was 32.70, okay? You could draw a line sideways through a year of up, down action with 2 peaks after then at 35 and 35, where you could draw a line through that ink and it oscillated either side of that price level, going nowhere. It had a sharp drop, like in early April, it had a real sharp drop. It immediately recovered, but it basically just lived in a zone. When we looked at momentum of that price action, we didn't get this erratic up-down action. We had a perfect tube of action. You could define, if you saw the momentum chart, which are in our weekend reports, it's like a perfect channel. Last Friday, when we closed up got up in the upper 34s again, not even getting back to the $235 peaks, it broke out of a whole year of perfection of a channel, meaning it's going to unleash itself now. There was a period back in 2010 when a very similar thing happened, where you could find a spot and it oscillated noisily sideways for a year, and you didn't know what's going on. And momentum developed a structure, a downtrending structure of correction. And when it broke through, silver exploded over the next handful of months. My assessment is not just because of that historic parallel, but because of other factors I see in play right now, technical factors, that in the next 3 to 5 months, we're highly likely to see silver well above 50. Once we get this up, I think the first surge is not even going to acknowledge the old dual highs at 50, which really were phantom events. In other words, we were up there for so brief a time, it was like gaseous. It wasn't even really getting up there. And as you said, in real dollar terms, real value, $50 don't mean anything. We have to go to about 200 right now to match those peaks in real dollar terms. But I think we're about to launch, this month being the initial launch month, for the next 3 to 5 months. And then you may get a pause, and then I think there's more after that even. But I'm focused right now just on this jolt that I think we're about to have. And I think it's going to blast out the old 50 highs. And that's, of course, when what? You're going to get all the public, which has ignored this beast the whole time, denied the reality that was under their feet, that with monetary metals rising, beating the S&P, by the way. Certainly gold. Even the gold miners, by the way, have beat the S&P since 2015, if you measure it properly. But I think we're about to launch. And I think in the next 3 to 5 months, you'll see a different reality than what we've seen many years.
Well, the way I look at it is not so much how high it can go, but how low the dollar can go. And in that, because really, it's not gold going up so much. I mean, obviously, gold has a volatility of its own, but it's actually quite low. But most of the move is actually due to expectations of lower currencies in terms of their purchasing power. That's something which is really driven by foreign interest. Now, for some time, we have seen the People's Bank of China buying gold, but they're not really buying gold. What they're doing is they're dumping dollars. And I think if you understand that distinction, then you actually get the story. That's the whole point about what gold is doing at the moment. Now, we had a very interesting moment when I think it was just after Liberation Day, when we saw the dollar fall and bond yields rise. Now, I mean, this, as far as market participants are concerned, shouldn't happen. If you get rising bond yields, you would expect to see the dollar rising. But what it was foreigners dumping US investments and dumping the dollar. And that was the key to it. Now, we've got a pause in that situation. And the pause, I suppose, is understandable given that Trump is backing off on tariffs. How much, we really don't know. He seems to have come to some arrangement with China, but we don't actually know what it is. But it looks like China's, if you like, control of rare earths has upset Trump's plans. But there is another thing in this, and that is that Trump is a spendthrift. He wants to cut taxes. He wants to eliminate income tax, indeed. I mean, part of his whole tariff plan was to return to the situation before the First World War, where there was no income tax, and the federal government, if you like, earned its revenues in tariffs. But that's no longer the global situation. The global situation is actually extremely dangerous. And I think what we're beginning to see is the global economy fraying around the edges. And I think we're beginning to see that, from various other major economies, we're beginning to see them stall. But this is very, very important, because as these economies stall, the US economy is likely to stall as well. It's bound to, for the same reason. Basically because of the consequences of tariffs and responses to tariffs and so on and so forth. Now, what this means is that there will not be the increase in the revenue from the private sector to support the cost, just the interest, if you like, the accumulating non-paid interest on government debt. So in other words, the slightest hint of a recession and the US government is in a debt trap, which basically leads to bond yields spiraling higher. And I would argue that that is already the situation. It's just that people don't really realize it yet, but they will wake up to it. And at that stage, we will have the situation again, whereby you see the dollar falling and bond yields rising. And they'll be talking about inflation, because what is inflation? Inflation basically is a fall in the purchasing power of the currency. So this is a situation which, of course, markets do not expect. If you talk to people in markets, they're saying, oh, we expect there will be 2 quarter point cuts in the Fed's rates this year. Well, that may well happen, but if it happens, what happens to the dollar? It's down the tubes. We go back to the dollar. The dollar is in a very, very bad position. So one way and another, I think this is just a pause. The trend, I think, when it resumes, will be extremely upsetting for not only the dollar, but also all financial instruments, dollar-denominated financial instruments. And by the way, that includes the equity market, which was very, very overvalued relative to what you get in bonds, without bond yields rising any further. It's a very, very important point. And remember that on the US Treasury's own tick figures at the end of March, they reckoned that $17.6 trillion of foreign investments is in US equities. Are they going to hang around and watch this? I think not. So pause, and I think the trend is going to continue, and it's going to be a nasty trend.
Michael, your thoughts on gold at present?
Yeah, well, Alasdair hit it on the head there, the dollar. Now, of course, there's 2 ways to measure it. One is the reality way, which is what does it really buy in real world terms? When I was a kid, a loaf of bread cost 20 cents. Okay. What does it buy now? Anyway, granddad's house cost $4,000. Now it's $420,000. Okay, median price. So it's the deterioration of the money unit itself. All of them are deteriorating. But when you compete them in the dollar index, so-called, which is primarily euro and the yen, constitute like 70% of the dollar index. When you plot that beast, we made a high and a rally high in the dollar at 115 in late 2022, and then it dropped sharply down toward 100. From 23 through 24, it oscillated in what was basically an 8% range, usually 100 to about 108, 100. It was just a nothing. It was a trendless mark in a very narrow percent range. It didn't create any wave effects. In March of this year, it started to roll over and got down to 104, which is right in the middle of that range, basically. And we put out a report saying, that's it, we've topped. Dollar's topped. Because the March close was 104.21. After that, it dropped another 5-6 points, dropped down under the 100 level. If you look at a price chart of the dollar index, you'll see that in 23 and 24, it kept making lows at 100. Well, we pierced that. As soon as we pierced it, went down under 98, shot up to 101, like, oh boy, I'm going to rescue myself. And now it's back under 98 again, quietly, not real volatile. The problem now is that there's another metric that we use. We use 3-year average momentum before it broke in March. The 10-year average momentum chart. If you saw that momentum chart, you would scream. Say, we're breaking the gates of hell here. When you close out a month below 98.35, to give you the number, you will blow a structure on momentum that if you just looked at the momentum chart, you'd say, my God, a multi-decade uptrend is gone. At that point, the sleepy beast, the quiet one, wakes up in terms of volatility. That's when they'll start noticing and feeling the impact of a weak dollar, not just noticing that it's drifting, but that it suddenly starts to cave. And that's when this beast, this asset category, suddenly becomes a factor in bonds, also in the stock market. As Alasdair said, the number of foreign investors is off the page compared to history. So they're going to be impacted not just by a stock market downticking or stalling, but by the dollar value of it. So that's going to be a new factor in all the markets, is the breakage of the dollar index versus the other piece of fiat, the yen and the euro. Not that they're better, but they are relative to the dollar. And that will have wave effects in other markets, which have not existed up to this point. And it'll also probably help cave the bonds. Right now, it smells of intervention to me. I don't know by what vehicle, but that bond market technically, after rallying up in early April to 122 on the long-term bond future, collapsed within 2.5 days to 111. That's a crash for bonds. And since then, it's done this, keeps making lows under 111, but won't get down to 110. And that happens to be important for momentum. If you get down to 110 on the bond futures, we're using September contract right now, and it's having a rally that it's up to 114. You get back down under that 111 toward 110, and it looks like technically it's ready to give a puke. In other words, the reality of the bond crisis, which has just simply been growing every decade, doesn't matter who's president, just keeps growing, the debt crisis, will maybe become reality. Finally, it faces up to reality. And that will have a massive impact on certain stock sectors. We're watching in particular commercial real estate, which is a component of the S&P. It's a small component. But if that commercial real estate sector, which 2 months ago we had a failure of one of the biggest shopping centers in the country, shopping center complexes, 800 million or 80 million. I think it was $800 million default on debt. Now, it didn't make the headlines on CNBC and so forth. But that's the kind of event that when that occurs, it dominoes into the banking sector. And then suddenly you should quit looking at NVIDIA and Microsoft. You better start looking at the ambush coming from the financial sector, which we think is coming, largely because of the bond market, which could be exacerbated because of the dollar. It's all coming into play.
Yeah, if you just Google Mloud Finance, you'll come across it, I'm sure. The actual address is alasdairmacleod.substack.com. My objective really is to help people become aware of the dangers that they face in financial markets, and to persuade them that really it's no longer a case of trying to accumulate wealth. You've got to preserve it, and you've got to start thinking that way. Basically, what it means is avoiding risk rather than embracing risk. It's a completely different psychology. And also I try and explain, really the role of precious metals. They are legal money and have been legal money since Rome's 12 tables going back to 448 BC, would you believe? And of course, all the European nations who came out of the Roman Empire colonized the world. So that is even written into America's common law. So you can see that all these things have been neglected. It's extremely important to understand the real position over money and the difference between money and credit, which very, very few people understand. So I have, if you like, a mission to educate and to help people survive what is going to be a traumatic event, because I see the destruction of our fiat currency system. That is going to impoverish virtually everyone in America, Canada, Europe, UK, Japan, and quite a number of other currencies. And I think you'll find that, the Asian bloc, the Asian hegemons, they expect this. They know it. That's why they've been buying gold. They've been selling down our currencies. So I just want people to understand what the hell's going on and just get out of their own parochial and small world of, stocks going up or, I don't understand gold. Why is gold going up? I should sell it, but I haven't got it. Come on, wake up. This is extremely important. So that's my mission.
From Alasdair Macleod's warning of a collapsing dollar to Michael Oliver's momentum signals flashing red, one thing is clear. The storm is no longer coming. It's here. Gold and silver aren't just hedges anymore. They're becoming lifelines in a system that's breaking apart. If you're watching this, you're already ahead of the curve. So don't stop now. Hit like, subscribe, and stay locked in, because the next move in this market might be the one that changes everything.